Hi everyone and good evening. This is Muhammad Burqan, market analyst in StarTrader. We'll be just waiting for 2 minutes until we gather along in this webinar, and we will come back together. Hi everyone and good evening. This is Muhammad Burqan, market analyst in StarTrader. Kindly write me in chat if the voice or the image are clear or not. All right, that's great. Then I assume everything is all right. Can you hear me well and you can see my screen? So today's topic is about an important thing in the market, in the advanced kind of market analysis, which is commodity currencies. It's a way we read the movement of certain currency based on a commodity in this related to this currency traded in the market. We have clear and obvious and famous examples in the market, and we have some are hidden or indirect correlated commodities to some currencies. In this webinar, I will assume that you have attended our previous webinars and you have background about the basics and the beginners topics, because here we'll be talking about correlation between currencies and commodities in the market without going into details of how to analyze each one of these, but we'll be talking about how to read the movement of each one of these based on the correlated currency or correlated asset. So let's hop on and start talking about the commodity currencies. Traders can use the relationship between markets whether currencies, currency to currency, or asset to currency, to identify the future price of each one of these. One of the most famous examples are gold and US dollar, since both of them are considered safe havens, so they have negative correlation together. So the movement of US dollar and the gold, which is the yellow metal, is negatively correlated, means they move in opposite direction in the market for some extent. We can't say 100% correlated or 100% negatively correlated, because sometimes the movement in the market might take both of them in the same direction at some point. But in generally, we are talking about general correlation between some kind of currency and some kind of asset or commodity. We have other examples than the US dollar, which have strong correlation based on the interest of the export of that country, instead of just considering the risk factor of the market. Some of the most famous examples are the loonie, the Canadian dollar. We have the Aussie, the Australian dollar, and we have the Kiwi, which is the New Zealand dollar. The relationship between Canadian dollar and the crude oil is very known in the market. It's well-known relationship in the market. They are positively correlated. So once crude oil went up, we can understand and we can expect the loonie to go up. That's because the Canadian economy relies heavily on crude oil. It happens on the other direction also. When crude oil prices go down, then I expect Canadian dollar to go down. Why is that? Again, because when the prices go up, the country as a whole will generate more income. We will be talking about these details later. Australian dollar is also the same, but in Australia, it's not about crude oil. It's about gold and iron. So the highest percentage of exports in Australia is gold and iron. As Australia is one of the largest iron exporters in the world, I expect the movement in Australian dollar based on the movement of iron prices. So the more people, the more growth we have in the market, and the more infrastructure are built in the market, the more iron will be demanded. That leads to Australian dollar to go up, because Australia as a country will generate more income. That will increase its GDP. Moving next to the Kiwi. Kiwi, or the New Zealand dollar, is very known for its correlation between the kiwi and agricultural commodities, specifically dairies. So because of its positive correlation with the CRB, Commodity Research Bureau Index. This index is a general index mainly known in New Zealand and mainly known for its correlation with the kiwi. This index measures average price for certain set of commodities and its movement. It's kind of the CPI, Consumer Price Index, but instead of measuring the inflation, it will be measuring the value of these assets themselves. Here we have, you can take screenshot of this one. Here we have a clear identification of each currency with the assets or commodities related to it. You can take screenshot for this one and keep it for your future reference, because it will be very helpful as an advanced tool and advanced reference in the market. This goes beyond technical analysis and fundamental analysis. This is more into economics and the relationship between countries and the market itself. Talking about one by one of these currencies, we have gathered these three as examples only. We have other examples in the market we'll be talking about later on, but just to understand the idea of it, we gave you these three examples. They are clear, straightforward, and the correlation is strong. So you can rely on this in the future. Before we start talking about one by one, if you have any questions, do not hesitate to type it in the questions section. If you have any comments, you can also type it in the questions settings or in chat. Kindly, if you have any issue with the voice or with my screen, just let me know also. Okay, hopping on for the Aussie. The Aussie, or the Australian dollar. This currency has very strong correlation with gold and iron, because there is huge part of its exports for Australian exports comes from iron specifically, and other part comes from gold. There are other metals like copper, like industrial metals, but mainly with iron. Iron is used for buildings, for infrastructure, for many things, and it's one of the most used irons in the world, metals in the world. This will lead us to the other point, which is if we, at the start, I mentioned that US dollar and gold have negative correlation. When we are talking about positive correlation with Australian dollar and gold, that leads us that we have negative correlation between Australian dollar and US dollar. So the greenback goes up, that will lead the Aussie to go down. That by default comes from the correlation between Australian dollar and the gold, and the negative correlation between the greenback, which is the US dollar, and the yellow metal. For example, in the market, we're talking about nowadays. We're talking about interest rate hikes in the market. We have interest rate hikes came from Federal Reserves, which is the central bank of the United States of America, that led the US dollar to go up, mainly measured by the US dollar index. We are seeing the US dollar index going up. By default, we can take a look without taking a look on the Australian dollar. We can know that it's going down and it's weakening, not just because the US dollar is going strong, but because we have negative correlation between US dollar and gold, and positive correlation between gold and Australia and US dollar. So this point is clear so far. We are not talking about fundamental analysis now. We're not talking about technical analysis. We are just talking about correlations in the market. So if you have any idea with correlation itself, just please let me know. For example, we have in the market, for the time being, we have a slowdown in the growth in the Chinese economy, which is the second largest economy in the world. And we know that Chinese economy relies heavily on real estate development. So when the real estate development section or sector slows down, that means they have less buildings to develop. That means they have less iron to import. As world's largest iron importer in the world, their main supplier is Australia. So we can think about it this way. We have the largest, the second largest economy in the world is slowing down. That will take us to the idea that their import of iron is going to be declined. That will be reflected on the Australian dollar. In this case, the exports of iron from Australia to China will be declined also. That will reflect on the Australian GDP, which is gross domestic income, and that will also reflect negatively on the Australian dollar. This way, we have general idea about the market just by knowing that in China, like for example, Evergrande last year, which is the largest real estate developer in China and the largest debited company in the world with 300 billion US dollars in debt, slowed down and were about to declare bankruptcy. So this will give us an idea that the real estate development sector is going down. That will take us to the Australian dollar is going down. We can go short sell on Australian dollar just based on the idea that the real estate development sector is slowing down in China. I hope this is clear. I tried to explain it in multiple ways with different examples about this, and I hope it's clear. If you have any question, just don't hesitate to ask me. Moving next to the loonie. The loonie is straightforward. Canada relies on exporting crude oil, mainly exporting crude oil to the US, which is the world's largest crude oil consumer. Within these conditions in the market nowadays, where we have high demand on crude oil, and yesterday OPEC Plus declared that they will reduce their crude oil supply, that will lead us to an increase in crude oil prices, whether now or in the future. Instant idea that Canadian dollar will go up. Why? Because the prices of crude oil going up. Canada as a country will have more income generated by selling the same amount of crude oil without even bothering of increasing the amount of they are producing. That will lead us to their currency, which will also go up because the economy as a unit is increasing and nourishing. This is a straightforward relationship, and that's basically how the market is going up. So when Canadian dollar goes up or increasing in value, that will lead the pair, which is USD CAD, US dollar Canadian dollar, to go down. Why? Because it's an inverse currency. That's what we can see in the chart on the screen here. If you don't know this information, I recommend you to go to our YouTube channel and watch the videos about the basics and essentials of trading in financial markets, because this was explained in details in our first two webinars. For this, at this moment, I expect you to have full idea or full understanding of the pairs, inverse pairs, and market movement, so I can explain the relationship between these products. Going back to the loonie, for example, we have, for the time being, we mentioned that OPEC Plus is reducing production, means crude oil prices are going up, means the Canadian dollar will be stronger. Since it's an inverse pair against US dollar, that will push the pair down. I can go short selling directly once I knew about the OPEC Plus news. That's how we act in the market. That's how we think in general idea about the financial markets. The correlation and relationship between each product, each news, each economy. So far, it's clear. If you have any question, do not hesitate to ask. I keep repeating this too much in my webinars because I want to encourage you to ask any questions you have in your mind. Mr. or Miss Andrea, I can see hand raised. If you have a question, don't hesitate to write it in the questions section. All right, we'll be moving next to the Kiwi, or what we call the indicator currency for all commodities. Once this currency is going up, we know that we can expect uh, a news about inflation, not because the currency is leading the inflation, because this currency, the value of this currency comes from the value of the commodities it has a correlation with. In general, we can talk about the CRB, or Commodity Research Bureau Index. You can take a screenshot for this slide because it's very important to go and research about it. The Commodity Research Bureau Index is an index that reflects the value of all commodities linked to the Kiwi, or commodities in New Zealand in general, which its economy relies heavily on agricultural commodities. We are talking about wheat, we are talking about dairy products like milk, cheese, and other things like that. The prices of it in the market goes up, means the Kiwi will go up, not because uh, of the commodity itself, but because of its effect on the economy of New Zealand. The New Zealand dollar is linked directly to the commodities in general because of the commodity as a whole makes a large part of New Zealand exports. We're talking about agriculture, animal, agricultural products, including whether animals, they are exporting a huge part of lamb and sheep to the world. They are exporting dairy products as the product of these animals. It's easy, it's simple. When we are talking about COVID-19 restriction, World Bank released a report indicating that global consumption of food is increasing because people are just quarantined in locked places. So the increase in the value of the increase of the consumption as a whole in the world will affect directly New Zealand dollar. And here it will take it up, and we can then buy it once we have this news, and we can sell it on high and make profit out of it. The effect of this news is not always the same, but the general idea, we can have good general view about what details we can talk about, or what trades we can discuss in the market, or what opportunities we can find based on news. Here we covered these three examples. Now let's think about examples in the real world in the trading community. If we are talking about, for example, coffee Arabica, for the past 2 years, more than 100% the price of coffee Arabica has increased. First thing we can think about, I can go buy Brazilian real, for example, because the largest portion of Brazilian exports come from coffee. That will take it up, that will make me some profit out of it. Other currencies we can think about also, for example, the Chinese currency, which is the yuan. Chinese yuan is directly linked to the real estate sector. Once we read any news about the slowdown in global real estate sectors, we can think about a decline in the value of Chinese yuan. That will help us to sell Chinese yuan, whether to buy dollar against Chinese yuan or just go short sell Chinese yuan. That will help us to make some profit in a smart way without relying directly on technical analysis or fundamental analysis that might sometimes mislead us due to its geopolitical effect or to the deep details in these products. The correlation and relationship between commodities and currencies used to be called old people trading analysis, which is actually the first and the most basic type of analysis, but we tend to explain it after the technical and fundamental analysis just to make sure that you as a trader have an idea about how to analyze the market in the modern and most practical ways, and then you can apply this knowledge into commodity currencies trading. Fun fact, what is the name for these currencies? It's called COMDOLS. COMDOODOLLS, which is commodity dollars, because most of the most famous of these are these $3: Canadian, Australian, and New Zealand dollars. If you have any questions for the time being, if you have any idea about or any example about the topic we're talking about, do not hesitate to ask me. I will give you just a couple of seconds to write your questions and I will come back to you. Yeah. Yes, Mr. Ali. There is also a strong relationship between ruby and gold, because India is the largest gold importer in the world. So the increase in gold prices will affect negatively on the value of the ruby. That's good note for it. Yeah, it's the same concept, but in an inverse way. Instead of being an exporter for gold, we are an importer in this case. So the higher the price of gold goes up, it will be negative effect on the ruby itself. Means it will have negative effect on the Indian economy as a unit. Yes, we have other examples about that. We can talk about other examples. For now, we have Kuwaiti dinar, we have Qatari riyal, we have UAE dirham, we have Saudi riyal. All these currencies are directly connected to the energy market. For Qatar, for example, one of the largest exporter of liquid gas. When we are talking about winter, it's coming. So cold weather is coming. The main source of heat, mainly in Europe, is gas, heating gas. So the Qatari riyal will be stronger. The economy in Qatar will be booming and nourishing during winter because of the increase of demand on their products. So the main product for Qatar is liquid gas that will be exported to Europe on higher prices because the demand will be higher, means the prices will go up. That will lead us to more GDP in Qatar and an increase in the buying power and the value of Qatari riyal. Kuwait, UAE, and Saudi Arabia, they have also positive correlation between their currencies and crude oil because they have a huge part of their GDP come from crude oil exporting. There are many other examples, but these are the most famous ones. These are the most easy and straightforward ones. If you want to talk about some more examples, we can talk about, for example, the euro. We can talk about sterling pound. These currencies are negatively correlated with the crude oil because they have high crude oil consumption, but they don't have production in their lands. So they have to import it. When they import crude oil or heating gas from other countries, when they're talking about, for example, Mr. Andre, I didn't get your question. If you can please just retype it or explain it. So yeah, in Europe, for the time being, we all hear about the European energy crisis. This crisis came from the difference in or the cut of Russian crude oil imports to Europe. Since winter is coming and the cold weather is on the way, that will lead to higher demand since they don't have too much crude oil already, so they will have to buy more. Buying more on higher prices will affect negatively the GDP of European Union. That also will affect negatively the euro as a currency itself, because that will cause higher pressure on the economy as for the European Union as a unit. Yes, Mr. Yes, these countries are Brazil, Russia, India, China, and South Africa, for example. Each one of these countries has their own kind of correlation between their currencies and the market. We spoke about China, for example. Spoke about India also for some commodities. For sure, there will be other correlations in the market between their currencies and other commodities. For Russia, for example, crude oil. Russia is one of the largest crude oil exporters. So the increase in the value of crude oil, that will be beneficiary to Russia as a country. And it will be beneficiary to their currency. Everything is clear so far. I hope everything is clear for the time being. And yes, Mr. Andre, I will explain all of this once we confirm that everything is clear with everyone. All right. So I hope I covered everything related to this topic. I will come back to your question, Andrea. And thank you everyone for watching or attending our webinar here from StarTrader. All our webinars are for free. We are all here to help you, and everything is at your service. If you have any question, feel free to contact us. If you have any question, also you can contact your account manager at any time, any point, and they will help you from StarTrader. It's countries of BRICS, for the ones who want to know about it. It's a kind of federation between countries. We have Brazil, Russia, India, China, South Africa, and Argentina has formally applied for it, not yet approved, but might be approved later on, for economic cooperation between these countries. There are several ways to cooperate. There are too many terms for the cooperation between these countries. But yeah, export and import with favorable prices is one of the conditions between these countries. So any changes in one economy of these countries will also be reflected on the currencies of other members. That's one of the relationship of BRICS countries. For just this is a side note after the webinar. Thank you for this question, Andrea. If you have any question later on, don't forget to contact your account manager. Don't forget to contact us whether on chat on our website, or you can also follow our daily reports on our website to read about the market, the news, and technical analysis, fundamental analysis also. Have a nice time, have a nice day, trade safe, and trade with confidence.